Friends, good morning. This is my fourth video on implementation of Basel Accords in phases. In first video, I have covered the various types of risks a bank faces while playing a role of financial intermediary. Second one, I have discussed about the G10 countries and other countries who are the members of this BCBS. BCBS is a set of international banking regulations developed by Basel Committee on Banking Supervision. In this video, second video, I have discussed why for Basel Accords, what is Basel I Accord and what is Basel II Accord. In the third one, I have discussed on Basel II and Basel III Accords and the difference between this Basel II and Basel III. In this fourth one, I am going to discuss about the systemic risk. What are the key characteristics of systemic risk? What are the sources of systemic risk? And how the Basel III have advised the bank to address the systemic risk. So friends, what is this systemic risk? Systemic risk refers to the risk that a financial institution's failure or distress could trigger a broader instability in the financial system, potentially leading to widespread economic harm. Now, what are the key characteristics of systemic risk? First is contagion. The potential for a financial institution's failure to spread to other institutions or market. Then interconnectedness. These financial institutions are interconnected through various financial linkages such as loans, derivatives or other financial instruments. Third is systemic importance. The potential for a financial institution's failure may have a significant impact on the broader financial system and economy. What are the sources of systemic risk? Large and complex financial institutions can pose significant risk due to their interconnectedness and their potential impact on the financial system. Second is interconnectedness. Financial institutions, they are heavily interconnected through various financial linkages, and this interconnectedness can pose a systemic risk. Liquidity risk. Financial institutions that rely heavily on short-term funding, and this can pose a systemic risk if they are unable to meet their liquidity needs. Now, how to address this systemic risk? Basel III have advised measures to address this systemic risk. Basel III categorizes systemically important financial institutions, and they introduced a stricter capital requirement and other measures for CP, that is systemically important financial institutions, to reduce their systemic risk. Basel III also introduced capital surcharges for CP to reflect their systemic importance. Basel III introduced new liquidity requirement. First is liquidity coverage ratio and net stable funding ratio. The ultimate aim is to reduce the liquidity risk and promote financial stability, because liquidity coverage ratio takes care of the short-term obligations while net stable funding ratio takes care of the long-term obligation. And by addressing systemic risk, Basel III aims to reduce the likelihood of financial crisis, promoting a more stable and resilient financial system. I have already told you that resilience means ability of one to face the very critical situation, and to come over this critical situation is known as resilience. The new liquidity requirement in Basel III, they are designed to ensure banks have sufficient liquidity to meet their short-term obligations and long-term obligations. Now, what is this liquidity coverage ratio? This liquidity coverage ratio requires banks to hold sufficient high-quality liquid assets to cover their total net cash outflows over 30 days stressed period. This ensures banks can meet their short-term liquidity needs in times of crisis. Then net stable funding ratio, as I told you, this is taking care of the long-term obligation. This aims to promote long-term funding stability by requiring banks to maintain a stable funding profile related to the liquidity profiles of their assets and of balance sheet activities. This reduces banks' reliance on short-term wholesale funding and encourages more stable sources. These new liquidity requirements in Basel III, they are designed to ensure banks have sufficient liquidity to meet their short-term and long-term obligations. These liquidity requirements are very much crucial in preventing liquidity crisis and promoting financial stability. Banks were given a period for implementation from 2013 and 2019 to adapt to this new liquidity requirement. So friends, I am concluding for this video. In fifth video, I will take care of the capital buffers, capital conservation buffer and counter-cyclical capital buffers. Hope my friends, you are enjoying these videos. You are getting updated with the help of these videos. If you like these videos, kindly like this video, kindly subscribe for this video, and if any suggestions are there, kindly give to me. Thank you very much. Goodbye.